We are back with financial consultant and chartered financial analyst John Rhodes. He manages the Charles Schwab branch here in Augusta, and he joins us this morning to break down the stock market and what things are looking like at this time of year. And great to see you again.
Thank you, Cliff.
We have said this back and forth the last couple of months you've been here. It's up, it's down.
Yep.
It's ebbing in, it's ebbing out.
Right.
But we've got good news this morning, right?
We do.
How have the markets been since we last saw you?
Very positive. We actually closed at an all-time high yesterday on two of the indexes, the NASDAQ as well as the S&P 500. And so, you know, economic growth is turning out to be much more resilient than a lot of the forecasters had predicted earlier in the year. There were a lot of concerns, obviously, about tariffs and what have you.
Right.
And I don't know if you remember, but one of the things that we talked about was that GDP in the first quarter, remember gross domestic product, the way we measure the economy, was a negative number. It's a negative print because of the volume of imports, which actually detract from the GDP reading. Well, now those goods are in the U.S., and so they're contributing to the economy. So we have to, you know, once they get on shore, you need to move them around, move them to distribution centers, move them to the retailers, then the consumers buy them. That's all very, very positive for the economy. So things look very positive for the economy through the balance of the year.
Okay, good. Yeah. Now, there were some announcements with the Federal Reserve last week.
Well, actually, that's coming up next week.
Oh, coming up next week.
Right,
okay.
right. So next week, the likelihood of an interest rate cut is very, very low for next week, but they could surprise us. There are a couple of Fed governors that are beginning to voice support for a reduction in short-term rates. The important thing to be aware of is the Federal Reserve really only directly controls one rate. That's the overnight rate. It's the rate that they credit bank deposits with, or bank reserves, really. And that presently is benchmarked or set at a range of 4.25% to 4.5%. Oddly enough, the 10-year Treasury, whose yield is set by the marketplace, by the volume of buyers and sellers, is 10.36 or 10.37%. So roughly, let's call it 10.4. So you are, I'm sorry, I said 10, 4.4.
Okay.
So 4.3 to 4.4 is the difference in rates between overnight and 10-year. It's very, very, what we call a very, very flat yield curve.
I think we were looking at like 10.4 back during Reagan's time, and things like that, too.
I apologize for misspeaking, right?
Okay. What about investing right now? How should investors be positioned with kind of this uncertainty?
As we discussed last month, index funds are a great way to go. Index funds give you participation in the overall market, and as demonstrated by the economic strength, the U.S. economy is going to be growing most of the time. It's going to be different sectors of the economy that are doing the best. What's very, very interesting is through the data as of Friday's close, the industrial sector is actually leading. It's up like 15% year to date, whereas the S&P 500 is up about 7%. So, you know, when people try to predict what they think is going to outperform, they very frequently have a regret that they miss out on other areas that did outperform. And the way to resolve that is just participate in the overall index.
Okay, you bring this up, and this is something we've talked about before, too, and not a question that we were planning on, but there's always been that kind of knee-jerk reaction, and something that we've talked about, again, as I've said before. The best reaction is to not react like that, correct?
Right, correct. It's some people call it contrarian investing, and very often that if there is a reaction that proves suitable over time, it's doing the opposite of what the crowd's doing, and it's tough to do that. It's very, very difficult to sell high and to buy low. And so the best course of action is just to be a steady investor over time. As we've said many times, investing is a marathon. It's not a sprint. It's not about trying to double your money in a short period of time. But if you successfully invest in index funds or in the broad economy, in the broad market, your money ought to double about every 6, 7, 8 years.
Okay, great. Where can people go to get more information on this, John?
Best thing to do is give us a call at 706-877-849-8350, or just go to schwab.com/Augusta.
Okay, schwab.com/Augusta, and you can talk with John and the crew over there as well to get you set up. John, great information.
Thanks
for
Cliff.
sticking around with us today. We appreciate it.
You bet. Good to see you again.
You too.